My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for registering for today's webinar sponsored by Emerald Creek Capital. Certainty during uncertain times, closing a CRE loan in 1 week. Our sponsor today is Emerald Creek Capital, launched in 2009, Manhattan-based bridge lender. Emerald Creek Capital has built a reputation as an industry leader in the alternative finance space. The firm provides short-term loans secured by commercial real estate in primary markets nationwide. With many banks inhibited by governmental oversight, borrowers are finding it more and more challenging to find credit. In contrast, Emerald Creek's unrestricted capital base and open door lending platform allows them to deliver fast and flexible loans tailored to the specific needs of each client. Capital is available for acquisitions, refinancing, repositioning, and other markets-driven opportunities. Emerald Creek Capital closed 45 transactions in 2020 alone, proving to be a reliable financing options for during otherwise challenging lending climates. The firm has provided over 400 loans across 28 states nationwide, representing just under $2 billion of capital deployed. Our moderator today is Mike Cleaver. Mike Cleaver is a managing director at Emerald Creek Capital with over 15 years of experience in the commercial mortgage industry. Mike is responsible for debt structuring and loan underwriting, as well as managing the origination team. He works directly with commercial mortgage brokers and borrowers to find solutions to complex and time-sensitive financing needs. In 2015, Mike launched Emerald Creek Capital's second office location in South Florida and has since played a significant role in their nationwide lending activities across 28 states. Mike has structured and facilitated the closings of more than 250 transactions, totaling more than $1 billion in short-term bridge loans. Emerald Creek's guest panelists are Karen Kozlowski, partner, Thompson Hine LLP; Judah Neuman, Vice President of Meridian Capital Group; and Ori Forger, Executive Vice President of Kensington Vanguard. Let's start off with Karen. Karen, can you please just give us a 1-minute intro bio on yourself, please?
Sure. So my name is Karen Kozlowski. I am a partner in the real estate group of the firm Thompson Hine. I'm in our New York office. We are a Cleveland-based firm with 8 offices, several of them in Ohio, Atlanta, DC, Chicago, and of course, New York. I've been practicing commercial real estate on behalf of lenders for a long time. We were joking. Before this, it feels like a really long time after the last year. I focus mainly on real estate finance portfolio loans. So all of my clients, for the most part, hold their paper. They may be bridge loans or longer term loans, but it's much more of a focus than on, say, CMBS or permanent loans. I'm happy to be here and looking forward to discussing closing deals in short timeframes.
Thank you, Karen. Judah?
Sure. So I'm a vice president at Meridian Capital. We are, I think, the largest privately owned mortgage brokerage in the country. Work out of the New York office and focus on a variety of asset types and deal with a variety of lenders. So everything from multifamily to industrial to retail to hospitality, and work with lenders spanning the local savings banks to CMBS lenders to life companies, bridge lenders, and everything in between.
Thank you. Thank you, Judah. And Ori.
Hey guys, thank you, Anthony. My name's Ori Forger. I'm a shareholder with Kensington Vanguard National Land Services. We are the largest privately owned title agent in the country. We are doing everything from large commercial transactions to small residential refis nationwide. And a big part of our focus has always been, client relations and networking. And that's really, where I spend most of my time trying to help my clients find, whatever it is they need. So these days, it's a lot of Zoom calls like this and trying to help the equity find the sponsors, et cetera. And thanks for putting this together.
Oh, thank you, Ori. Hey, guys, you guys all sound very great. A lot of impressive resumes. Without further ado, ladies and gentlemen, Mike Cleaver.
Thank you very much. And thank you to the three of you for agreeing to come on this webinar. It's great to have you. As Anthony mentioned, we're Emerald Creek Capital, and we're largely in the business of closing loans quickly. And when somebody approaches us to close a loan quickly, it's not just us who actually closes the loan. There's so many people involved. It starts with Judah, it flows through us, goes to Karen, ends up with Ori. And when we tried to come up with a topic for this webinar, we thought it'd be great to talk about, what goes into actually closing a loan quickly, what types of scenarios need to close quickly, and your guys' experience not only with private lenders like us, but just working with other lenders in the banking world. So without further ado, I thought maybe we could talk about just the types of scenarios in general that come up. Judah, maybe we could start with you. When you have a client who says, I've got an issue, I need to close the loan in a week, or is it not that simple? Usually it's because a bank maybe was in process and something happened. What's your experience with borrowers?
Right. So in this environment, there's a couple of scenarios in which we're seeing clients having to close quickly. One is on the acquisition side, where there's a deal to be had, and because the seller knows that he has a captive marketplace, he puts a hard date on it and says, okay, I'm willing to sell it to you, but you got to guarantee me you're closing by a certain amount of time. Otherwise, you're not getting the price and you're not getting the deal. So that's one scenario that we've seen. We had a TOE at the end of December under similar circumstances to that. On the other side, as you mentioned, we have a fair amount of circumstances coming up where guys have come down the road, and perhaps on the multifamily side on a refi, and perhaps in New York where you're seeing occupancy drop and the numbers are trending down, and all of a sudden a loan that worked, when we started out a month ago or 2 months ago is not working anymore. The bank is pulling back, or they're getting retraded on proceeds. So, and they have a maturity coming up and not really much of a choice, and they have to get out of it. Another situation where we're seeing it is on workout scenarios where, banks want to put clients into workout. And if there's a way that we can get a client a deal to kind of hold the fort for a year or two and give them some flexibility, even if it's at a bit of a higher rate, but get them out of that scenario where they have a gun to their head. That's, I think, the third scenario where we've seen a fair amount of quick closings.
Is that similar for you, Karen? Do you see other scenarios where you see quick closings? What's your experience been, particularly in the last 12 months?
The last 12 months, it has really revolved around either whatever the financing was that was in place is no longer viable, or equity. Sometimes equity has pulled out, or the equity that was going into a deal isn't what it needs to be. So there's a shortfall, a little bit of workouts. Luckily, I haven't seen too many of those. I'm hopeful that that's not on the horizon. I think the market is still healthy enough. So it's definitely sort of the areas that Judah mentioned is what I've seen the most.
And Ori, are you guys, when people come to you, are there certain scenarios where you guys have to put together title quickly and close in a week?
I'm still waiting for a scenario where we don't have to put together a report quickly. For us, it's a hurry up and wait business. Everyone's in a rush until they realize that title's going to be there long before they're ready to close. But on those deals that actually are trying to close within a week or 10 days, the title process, is somewhat municipality to municipality. It's whether it's electronic or you have to go to to pull every document at the county clerk's office is really, it unfortunately controls a lot of the process. And we are under the gun trying to expedite things, but to the extent that it is within our control, once the documents get to us, we can get them out same day. In some places it'll be 3 weeks, in some places it'll be 3 hours. So we always try to be upfront with our clients to let them know, don't wait until you actually have a signed contract. If you think this may be under the gun, we're happy to run 10 reports to only close one deal if that's what it takes. But we are not in full control in certain areas. So.
When you mentioned expediting things, I mean, when a deal's submitted to us, one of the reasons we're able to excel as a private lender that needs to close quickly is because we're able to underwrite and approve a deal sometimes on the spot or in as little as 24 hours. But when you guys are working with borrowers, when you're working with other attorneys and other third parties and moving pieces, how do you prepare clients? How do you guys expedite things on your end? Judah, it probably starts with you with the borrower. You say, okay, if you need to close in a week, this is what you need to do on your end.
Sure. So the most important thing from a client perspective is that they have all their information in order. There's a certain standard list of items that any lender's going to need. So whatever that package is, to have them, get their stuff together and prep them up front and say, we can get it done, but it's going to depend on you and your attorney getting everything over to the lender as quickly as possible. And I just think the other most important part is that when you're in that scenario is picking your lender wisely. And there might be somebody who's got the rate is a quarter point better, and maybe there's less points up front or different things on the structure. But the biggest thing is certainty of execution. And so, we try to counsel clients and tell them that, this deal might look good on paper, and it's my job to show them that as well. But at the end of the day, to push them in the right direction. And like somebody like Emerald Creek, where I have had a lot of good experiences, is somebody that I would recommend and say, hey, they're great to work with, and they'll be able to get it done in the right time frame, so long as you have everything together. So I think the biggest takeaway from the client perspective is, if you're in that situation, you have to have your paperwork together, you have to have your information together, and collaboratively choose the lender wisely.
And Karen, you're largely working with the borrower's attorney as well as the lender.
Mm-hmm.
When you're trying to expedite things in terms of documentation goes, what do you do to make sure that happens? And what are some of the challenges that you face when moving with when you have so many moving pieces?
Sure. So I agree wholeheartedly with what Judah said. We need the key components to the deal: title, survey, org docs, diligence searches. Everyone who closes commercial real estate deals knows what I'm going to ask for. So to have that up front certainly goes a long way to expedite the deal. I view it as sort of third-party things that are out of our control, because I don't worry about documentation. I can draft loan documents in whatever time frame you need me to do it. That's my job. But things like making sure that Ori's ordered title, he's ordered the diligence searches, the municipal searches, that has to be done ahead of time. The other thing I will say, as far as a tip in closing things in an expedited fashion, when a deal comes to us, and this is really for borrower's counsel or the borrower to tell their lender, if you know of an issue, there's hair on the deal, there's something that I'm going to find when I do my diligence, tell us up front. What I think a lot of people worry that if they say, okay, there's this one issue, I'm sure we can work around it, that somehow it's going to delay closing in a week. It really won't. What delays it is if we're 5 days into that week and I discover an issue. And then that's where it unravels. So I agree with having all the documents up front, but I think being honest and open about what the deal really is also goes a long way.
Yeah, that's a really good point. We deal with that on our end too, because when we're underwriting a property in 24 hours, if we're missing a piece and we're putting a loan amount on that and we're committing to it in a very short time frame, and if down the road we find out that one tenant isn't actually, this is a specific example to pandemic, we have a rent for $3,500 a month, and then we find out that person's actually getting concession. They haven't paid in 6 months. It's okay. We're fine to do the deal. We're not going to change it, but it changes our underwriting, which is always better. Because we can move so quickly, it's better to have that information up front. And then Ori, on your end, when you have to close quickly, is there anything you can do internally to speed up the process as far as title goes?
It's really asset class specific, but other than throwing bodies at it, there's once we get the abstract in, we can put as many people on to get it out as quick as possible. But I think we typically tell clients it's 7 to 10 days from the time we receive the report till the time we get it out. And I recently had someone asking me, what do you do for the first 6 days? And I loved that question. It's great. It's kind of like when you go to the doctor's office and you just wait 45 minutes. Like, what are you waiting for, right? So it was a great question. And, I explained to them the way it works and how many moving pieces there are. We internally have 11 different departments within KV. And for any specific deal, you're not typically touching all 11, but there's a lot of moving pieces, a lot of pieces of the abstract that we need to collect. And usually at the very quickest we could get it back would be 3 to 5 days, because we're waiting for a lot of documents to come in from, these individual municipalities. And so, again, having the clients knowledgeable enough to start the process early is the best thing I can do. Beyond that, sometimes it is legitimately out of our hands.
Specifically to the pandemic, over the past 12 months, I was kind of curious how the shutdown affected your ability to close loans, I guess quickly, but just in general. From a lender's perspective, one of the things we ran into, especially nationwide, is we appraise every property we lend on. Even if we have to close in a week or 3 days, we get somebody into the property to at least give us a verbal value. So we have that information. When we're faced with a pandemic and nobody knows what's going on, the last thing an appraiser wants to do is go into an apartment building and walk every unit. So it changed our underwriting. We had to all of a sudden consider, lending on properties without seeing them, or potentially sending someone in with a video camera. And it was very unique. And I was really impressed by our team's ability to adapt, and everyone was working from home, working with you guys. And it didn't really affect our ability to do deals. In your experience, how did the pandemic affect your ability to close?
I'll answer that. Certainly in April, May, and even June, with the various clerks' offices being closed, it was very hard to close any construction loans. But more than that, it was hard to close modifications of construction loans, which have to be recorded per the New York lien law. I know that they've all, I think, been filed by now, but that backlog created certain challenges with lenders who wanted to modify construction loans, but they weren't able to file. You have to file for it to be compliant. So that was certainly a challenge during the first few months of the pandemic. And then recently, this isn't necessarily pandemic related, but the FedEx crunch that I think most of us are going through right now with the bad weather. I've had 4 deals in the last week have to come to a grinding halt because people don't have their signature pages. Acquisitions, financings, we've had to put things on hold because they're stuck in a FedEx warehouse in Memphis. So we'll eventually close, but it's come to a screeching halt. So there are only certain things that we can make sure get done, but things like that, again, out of our control, nothing we can do.
Yeah, Karen, actually, the construction loans were a big issue, I'm sure for everyone in the industry, but that was probably where we spent the most time in, March and April, other than the internal, of course, getting everything set up remote. But, the BLAs just held up everything, and in the state of New York, at least. And, right. And that, to your prior question, Mike, about how we can help our clients, expedite deals, there is a level of creativity that we probably all encounter in our day-to-day, where we can maybe, create some competitive advantage in our space by thinking outside the box. And it took about 2 weeks of hitting our head against the wall, but we were actually able to put together a workaround, if you will, where there was a lot of dry closings, where we actually restructured all these construction loans. Probably I should say about half of them were able to fit into this box that we created. But all credit goes to Chris Bellany, our head counsel, who created a workaround, which I think we then walked a lot of other title companies through. By necessity, a lot of these deals ended up being split, and it rippled. And I believe most firms in New York were able to do that in April, get these deals closed. But a lot of it was thinking outside the box, figuring out a way in unprecedented times. None of us have ever lived through anything like this, to get this done. And the construction loans was that was the number one issue we had. And to Karen's point, we were able to find some resolution for that. And so that was pretty interesting for early pandemic.
And in your experience over the last 12 months, were there things that affected your ability to close quickly? And did the actual transaction type make a difference if it was an acquisition or a refinance, or, were certain things not happening? Or I know Ori and Karen both touched on construction.
Right. So I think from our perspective, a lot of it came down to people, not being in their offices and being a little bit hard to get a hold of. And, we're used to, we, as you know, Mike, will call 5-10 times a day, until we get an answer on something, and just trying to track people down and, and line things up and be able to deliver to the client. That was definitely a challenge. There was a certain point in time where a lot of, lenders in this space just were on a standstill, and clients were panicking and what to do and trying to be creative with other lenders and try to, really hold the client's hand and navigate through it and continue, the way that we're successful is by, being out there and, and being relentless and trying to, make things happen for the client. So I would say for me, the biggest challenge really was, just continuing to stay on people and realizing that people were working all sorts of strange hours. And, typically in my business, sending out an email to a guy at 10 o'clock at night is not going to get me anywhere. And here I found it does get me somewhere. And 7 o'clock in the morning does get you somewhere. So just, adapting the approach and saying, okay, this is how people are working. This is how I can get somebody's attention. And emailing him at 12 o'clock in the afternoon when maybe his kids are having lunch with him is not going to work, although that's normally a time that will be successful. So I think navigating around the strange scheduling and which lenders were in the market and which were out of the market at any particular time, and staying in contact with all of those lenders to gauge when they're back in and what they are doing were some of the challenges. And some of the way that we were successful is by, just continuing to stay engaged with our lenders and, figuring out, on just something seemingly as mundane as timing, when the right time to call people is, and continue to get them at the right time to make things happen.
It's a really good point. If there's one thing that's true from the pandemic, it's definitely blurred the lines of like your live and your work balance. And I think it's actually a positive. I mean, it's, before if you heard someone's kids in the background or something, you might think like, like what's going on, but now it's become normal. It's normal to work from home. It's normal to have a Zoom call at 8 p.m. And I think that in the future, it'll probably translate to a better quality of living, especially for those people that were having, 2-hour commutes in and out of an office every day. It's okay to work from home one day a week and you can still be effective at your job. So I do think there's some positives, along with, maybe it's not okay to have a Zoom call at 9 p.m. at night, but specifically to property types, obviously some have been hit a lot harder than others during the pandemic. What's your guys' experience been in terms of doing loans? We're talking about closing quickly, but just in general, multifamily, office, retail, hospitality, is it, specifically with hotels? Do you guys see them coming back? Are they starting to come back? Judah, I know you're seeing everything, so we'll start with you.
So multifamily is still strong, certainly around the country. The agencies treasuries have gone up recently. So, the pricing's a little bit not where it was, but we had a run for, a few, really for the last 6 months, I would say, if not longer, where deals were getting done with the agencies in the twos with many years of IO. So multifamily is strong. It's been an extremely resilient sector of the market. Even in New York, where people think that it's not, it's still been quite strong. The collections have been pretty high in New York. Industrial is extremely hot right now, around the country and in the tri-state area. As you can imagine, retail and hospitality are a bit more of a struggle. And but by the same token, if you have strong national tenancy with long-term leases, that's getting done very well. I just quoted a CVS, on a 25-year lease, and triple stuff like that is getting done at extremely competitive rates. But retail, where things are closed and there's been concessions, and hospitality, as you can imagine, are definitely a little more challenging. But every deal can get done. It's just a matter of what it will look like and what the expectations are, and managing those expectations for the client.
Karen, when you're closing loans, are there specific property types that you're doing way more of than others in terms of multifamily, office, retail?
Definitely multifamily, and keeping with the theme of closing deals quickly, multifamily is going to win every time because you don't have estoppels or subordination non-disturbance agreements. Office, retail, even if it's a single tenant like a Walgreens or a CVS, they just take longer because you're going to need, at a minimum, lenders are going to want an estoppel to know that there's nothing going on. And you just can't get those quickly. Sometimes you can, not saying it's impossible, but it's much more challenging. Where multifamily is just generally easier. If the occupancy is where the lender's comfortable, you can close over that very quickly. Not seeing really any hospitality, not to say that I see all the deals, but certainly hospitality is taking a big hit. Retail, not so much, a little bit. Hospitality is the worst. I think it'll come back. I think as the vaccine is rolled out more and restrictions maybe lessen in the coming months, I think hospitality could come back. But to me, that's the sector that's hit the hardest.
With specifically to multifamily, how are you dealing with tenants not paying? Is there a lot of that? How are banks underwriting to that?
They are putting in COVID reserves, is a new big thing. I've never thought I'd have to use that as a defined term in a loan agreement, but now we do. So I think lenders are cognizant of the fact that this is going to be a fact of life and they still want to get deals done. So they'll work around it and they'll underwrite around it with things like a reserve.
Got it. So despite the income on the property being at one level, people are requiring interest reserves anyway, and they just estimate how long they think they're going to need it until people pay again.
Right, either an interest reserve or static reserve in the event the cash flow doesn't support the debt service. It can be somewhat flexible as to what they use the reserve for, and it takes on different types of reserves. But there's definitely many more reserves being held on these deals, especially multifamily.
That's for us, that's part of when we're truly faced with a quick closing, if someone wants to close in 48 hours, 9 times out of 10, we'll hold back the interest because it's hard to verify everything. So, and as a short-term lender, it works really well for us because it's very easy to hold the interest for the entire term of the loan over a period of 12 months, where I imagine for an insurance company that's writing a loan for a much longer period of time, there's more that goes into it. Or are you seeing the same when you're underwriting policies? Is that the same with you? Has it been mostly multifamily? Are you seeing anything, signs of life?
We work in all asset classes. I'd say, the upticks have been probably industrial. Is probably where we've seen more volume in, the last 12 months than maybe in 2018 or 2019. The multifamily market, certainly in New York has been kind of uneven for the last 4 or 5 years with the rent regulation stuff and the political climate, and then with COVID. But right now, with the exception of retail, I would say we're getting reports, we're getting orders on all asset classes. In all regions, a ton in the Southeast. We'll see what closes, Mike.
How about with locations? Does it make it at this point? I mean, certainly over the last 12 months, it's made it different. But now that we're seeing signs of a post-pandemic, vaccinated world, are you finding challenges when you're doing deals across the country? I know all 3 of you are active nationwide. If you're doing something in Florida versus Chicago versus New York, does it make any difference for you in the closing process? Is one easier than the other, or are they all more or less the same at this point?
For us in the title world, the closing isn't so different. The economics are very different. So, for anyone who's ever, looked at a deal outside of New York, you might look at the title bill and it's very different. So I'm living in Florida right now, and there are a few different mechanisms that buyers can use here to reduce the costs. And as a result, you'll see a different landscape and sometimes different quality for the agencies. And so very often when we're doing business, because there's not as much money to be made, the other parties we're dealing with are not up to the New York standard of the hours they put in, the speed at which they'll respond. And if we're trying to get a policy from the prior title agent, that, at 5:01 p.m. it might be, it might be ghost town over there, and it's just not the way we work. And so, again, we're doing deals in 42 states right now, and so learning how to navigate each state's works has been interesting.
That's interesting. And Karen, I know you're in Florida right now too. It's been as far as locations go, it's pretty amazing to see the different states having different levels of openness. I'm getting, as you guys know, I've run our Florida office I've run our Emerald Creek, Florida office for the past 5 years, and I'm going to continue to run it, although I personally relocated back to the Northeast. So I'm missing Florida right now. But having lived in Florida and in the Northeast during the pandemic, it's been very, very different. In Florida, I'm getting invited to in-person networking events. And where we are, in New York, I don't think anyone's had lunch in person together. Do you find being in Florida, there's more deals happening just by virtue of the fact that it's more open? And do you see that as a sign of things to come for other states that, are taking a more conservative approach or that have a larger population? And, like in New York, where you can't have everyone out and actively walking around and things.
It's interesting that you say that, because now that I think about the various states that I have pending deals in, the majority of them are states that lean more towards being open and having less restrictions. I don't know if that's more of a product, like you say, that people are either meeting in person or have the ability to make deals happen as opposed to either over the phone or on a Zoom. So there could be something to that. But Ori's point is interesting, because this is not even necessarily pandemic related. I've always noticed it's different to close a deal in, say, Texas than it is New York or Iowa or Idaho, Kentucky. There's definitely a different vibe, and your business hours in some of those states are really important. Don't call title in some of those states at 6 o'clock or your surveyor at 6 o'clock. No one's going to pick up. So you need to be mindful of where you are and where you're closing your deal, especially if you have a week time frame to close.
Jude, have you seen an uptick in deals outside of New York, or have you seen more deals happening in New York? I know New York in particular has been very much more shut down and has been largely affected more than a lot of other cities.
We have a lot of clients that just have loans maturing in New York. A lot of our client base is New York traditionally. I mean, we're national at this point, but there is a traditional base of New York clients. And so there's been a large volume of deals in New York. Definitely seen a migration of deals to South Florida, only because that seems to be the national migration of the people from New York, that they're going down to Florida and the Southeast. And, and this is not only from now, this is from the last couple of years. We see a lot of the younger guys, who are looking into getting to the multifamily space. They're not buying in New York because the upside is just not there. So whether it's, the Carolinas or Texas or Florida, the Southeast, and other places like that, that's where the deals are migrating just naturally. So I wouldn't say it's necessarily pandemic related. I think it predated the pandemic, but perhaps it's been accelerated by the pandemic.
How is it working with, working with different types of lenders? I'm obviously only familiar with the private lending space. It's what I've been doing for the last 15 years, but particularly over the last 12 months and into the future. How's the process? As you guys all know from working with us, our process is fairly streamlined. We'll give you an answer right away. We honor our rates. We either like a deal or we don't. If we like it and the borrower likes us and wants to do it, we move forward and we close. When you're working with the CMBS lender or an insurance or a community bank, how is the process as compared to a private lender different? And how is your process different?
So I'll start with that one. So, clearly, from a process standpoint, the private lenders, and especially the good ones with whom we have good relationships, and as I mentioned before, certainty of execution, the process speaks for itself. That's going to be streamlined. It's very flat, those organizations, and can make decisions quickly, and they say they're going to close, and, the ones who are good do close quickly. But as that comes with a cost, I mean, clearly it's more expensive, and some of the terms perhaps are not as favorable to the borrower. So that's, then you go to the bank world. But if you have to close quickly, most banks, can't move that quickly. They're regulated. They have boxes they have to check. They have underwriting standards that they need a full appraisal, unlike doing something like you mentioned before, where they can get a verbal value. So really, it depends on the time frame. And the biggest word that I would use in this context is relationships. You have to know who you can count on under these circumstances, and and go in that direction, even if it means paying up a little bit in rate.
I definitely agree with that. Private lenders, Emerald Creek being obviously one of them, they're very nimble, can close in an extremely short time frame, underwrite deals, and get it done. Not that institutional lenders can't. Certainly, what Judah just mentioned, relationships. There are borrowers who have very strong relationships with institutional lenders, and they can get deals done quickly. But generally speaking, there's just a longer process from appraisal to credit approval, especially since a lot of people aren't in person. So their credit committees are meeting by Zoom or phone calls, just seems to take longer. And I think a part of the issue is risk too. Private lenders, in my experience, are willing to take on a lot more risk than institutional lenders. And especially now, institutional lenders will only look at certain types of deals for certain sponsors in certain areas where, Mike, you and Emerald Creek, like other private lenders, will be much more flexible and look at different deals. So it's really almost night and day in my experience between private lenders and more of your institutional lenders, whether that be community-based or larger institutions.
Now, if I could add just one thing to that, I think one thing that we've seen under these circumstances where, properties perhaps have had challenges, how important it is for clients to think about their relationships and the banks with whom they have their relationships. And if you're somebody who does have significant deposits, getting somebody to guide you where you should keep deposits and which banks will allow you to leverage those deposits to get deals done under tight circumstances and who will work with you, as opposed to saying, oh, I keep my deposits in XYZ bank and I always do, and that's the end of the conversation. We have found very, very strongly that clients who have deposits at certain banks, local banks, can get things done that other people can't get done, and those banks will work with them. And to use your deposit, if you have them, to use your deposits wisely.
Or in your experience working with banks, do private lenders versus other types of lenders make your life easier, harder? Does it not make a difference?
It certainly makes a difference. I wouldn't say that it's typically the solution or the problem. I'd say for us, legal is probably where we see the biggest difference in how a deal, how smoothly a deal goes. If somebody tries to use a discount, mom and pop shop that maybe isn't focused on their asset type, it can be incredibly difficult because they don't really know what they're doing. Karen's firm is obviously a great firm. Using a well-known law firm can make all the difference regardless of the lender, because they'll be able to kind of coach their client through how to expedite what they need done. Again, getting to the out-of-state issue, we have worked with some lenders, especially small private lenders in other markets that are trying to do deals in states they're not comfortable with, and they just don't know what they're doing. It's a lot of hand-holding for us, but if there's strong legal and if the buyers know what they're doing, it's usually the lender doesn't really drive the process so much on the title side.
Got it. And then for the last topic I have, just kind of want to talk about predictions for the next 12 months. I mean, there's a very large divide of pessimism versus optimism out there by property type in the lending space. We know that there's delayed foreclosures. I've heard a lot in New York about a lot of banks that have loans on rent stabilized properties that are underwater. I've heard about backlog in New York with the courts. Obviously hotels, depending on leverage, CMBS loans could potentially be in trouble. And then there's others that say, once we're all vaccinated, once we kind of get back into the open and into the swing of things, it's not going to take as long as people think. Others say it could be a long, years ahead to get things back to normal. Some people think New York will come back. Other people don't. So if you guys each kind of just, I'm curious about your opinions. Judah, we could start with you. Pessimistic, optimistic.
Well, I'm optimistic, from New York, live in New York. I think things will come back. I think it might take time, but I think people have a lot of pent up, they just want to get out, and people want to go and want to do things. And I think, again, I don't know if it'll be complete, in the short term, but, New York has always bounced back, and hopefully it'll happen here as well. And in terms of things that you mentioned, whether there's backlogs and loans not working, that just creates opportunity. People have to sell, and then there'll be opportunity. People need to buy, and those loans need to be financed. So it's a big circle and a big cycle, and it'll come back. But having lenders out there who understand the situation and are nimble and able to get things done is definitely a good tool that we have in our quiver to help our clients. And hopefully sooner rather than later, things will be at least trending in the right direction.
So I don't know if I'm optimistic, because I'm looking out a window and there's sun is shining and it's 80 degrees, but I am optimistic for certainly the next year. As a finance lawyer, I tend to look at things in quarters. I lived my whole life in quarters, and first quarter is extremely busy. And it's not necessarily a carryover from things that didn't close in fourth quarter or things that were on hold from last year. It's new deals. So I always think that's a really good sign. As far as New York goes, New York rebounds always. I fully believe New York will rebound. And I also do feel like the backlog of either pending foreclosures or potential foreclosures is exactly what Judah said. It's opportunity. And I think that will create new deals. And I know many of these lenders don't want to foreclose and own these properties. So I don't think there's incentive for these mass foreclosures either, which means there's going to have to be ways to work out those deals. And whether it be new equity coming in or financings or dispositions and acquisitions, I think that's what's ultimately going to get us out. It's not going to be finished in the courts, but just my own optimistic attitude.
And yeah, to Karen's point about looking out the window and saying, I'm going to just do this for a quick second. So I am optimistic. I'm not sure what about. Talking to clients, it seems like, especially the syndicators, who are not necessarily putting their own dollars into deals or not a ton of dollars. I think that they're optimistic that they'll be able to find value, especially once, the 2021, 2022, I think there's going to be a lot of unpredictable movement. I've heard people talk about how a flight from New York to Florida might go up to $1,000, right? How a lot of the things that we've kind of considered to be the normal metrics are going to change because of buying habits and travel habits and living habits. And I have a few operator clients who are, I'd say, betting on some of these trends changing. And I think that similar to what we saw after Lehman and the little financial crisis we had in 2008, there was a lot of opportunity born out of that. A lot of people pivoted into real estate from other sectors, and I think we're going to see. I'm optimistic that we're going to see another surge in certain asset classes in certain markets. I don't know what New York's going to look like in a year or 3 or 5 years. I hope that it's stronger than ever. But I do think, there'll be pockets of activity in this country that are thriving beyond belief after this pandemic ends. So,
got it. I think you guys all three touched on the word opportunity, and I think that myself, I'm pretty optimistic by nature, but I think you're right that there's going to be borrowers out there. There's going to be investors and people that through what's been a tragedy will find opportunity, whether that's buying distressed debt or taking a chance on a vacant retail property where they don't have a tenant in there. And I know that, for those opportunities, if people have financing needs, Judah's the quarterback for that. Not every deal needs to close in a week. Sometimes people want cheaper rates. So I know you're a good person for them to reach out to. And, in terms of legal, if someone needs an attorney who can actually execute and close, and we'll return phone calls. Karen's your go-to, and Ori, you know, for anyone that needs title, you know, they get great service. And I can't thank you guys enough for joining me on this call. And I look forward to hopefully a good, certainly better than 2020, 2021. So thank you.
Thank you.
Thanks. Thank you, Mike. Thank you, Judah. Thank you, Karen and Ori. We do have a Q&A. We have some Q&A. We do have some questions that were sent in, and I am going to read off this first question in Q&A from Rolik Malik. Other than title, what's the next longest pole in the tent in the loan approval process? What is the shortest time frame you've clear underwriting queue for all and close on a loan? And any one of you guys can answer that.
Well, third parties traditionally are the other lead time item. So, you know, appraisal, property condition, environmental. And one thing that always sneaks up on you is insurance. That always seems to be something at the last minute that the lender has certain requirements, whether it's deductible, you have somewhere you're self-insuring, or whatever the case may be. Insurance always seems to be something that comes up as a last minute issue. Literally, as we're sitting here, I got an email about insurance on a deal. So we're pushing off to next week. So that's always something that we try at least to get the lender's insurance consultant in touch with the borrower's broker at the beginning of the process and try to work that out.
I'll add from a legal perspective, searches, you know, title, certainly when Ori does a title commitment, he has some basic searches that he does. A lot of lenders require more than that, pending litigation, tax liens, things like that. So find out ahead of time what the searches are that are required, because unless you use an expedited service like CSC, they can take upwards of a week.
Great. Karen, I find out that I need to close in a week. Is there anything I should start preparing ahead of time before the legal is engaged?
All the diligence that we've talked about, have it
Everything.
tidied up, ready to go, send with the first email. I mean, as I said, we'll get it done. That's our job. We'll review it. We'll draft the documents. But if we don't get those documents until 3 days in, that's just going to delay the process. So get all your third parties, all your diligence ready to go right away.
Great. Thank you, Karen. Ori, are there any exceptions that can be made in a title policy? And in what scenarios would this happen?
What do you mean by that?
I don't know. This is a question that came in. Are there any exceptions that can be made in a title policy? Are there any kind of like exceptions that can be made in a title policy? And in what scenarios would this happen? If there are any exceptions?
Yeah. So you know, title reports come back and there's a Schedule B in it, lists a slew of liens, encumbrances, violations. A lot of what title does is tells you what you're getting. And of course, the insurance is to say if we made a mistake, if somehow, you know, you're inheriting something that we have not pointed out. So, you know, a lot of deals close subject to exceptions. I mean, that's a part of buying, you know, property is understanding what you're getting. And so, yes, certainly buying subject to exceptions. I mean, Karen could probably talk about that, you know, as well, is a part of buying real estate. Inheriting hair is sometimes a part of buying valuable real estate, finding opportunities. You know, we fight constantly with clients, with lenders, with attorneys, trying to clear as many exceptions as possible so that the insurance covers, you know, said items. But, you know, if there's 20 items on Schedule B, we might be able to clear 15, 17, 18 of them, but you're typically going to, I mean, it might be an unpaid water bill. It might be a very small issue, but yes, taking a title subject to exception. And again, Karen, if you want to add anything to that, you know, I'm sure from your end.
Sure. No, I will add, obviously, depending on the lender and their appetite for exceptions in the title policy, there's ones that are obviously more of a concern than others. But Ori explained it well. One thing I will say is the counsels out there, or the borrowers, be mindful of the state that you're in and whether they actually issue the title policy at closing. Many states don't and won't issue it until the documents are recorded. So sometimes I view that as a window in which we may be able to resolve an exception, like an old memo of lease, for example. Or if an SNDA is required because you have a tenant who's recorded a memo of lease and you might not get it in time for closing, but you'll get it, say, 2 weeks later. And as soon as title has it, they can remove that exception. You have a window in which that exception could be removed before the policy is issued. So that's also a way to kind of get around if you're under a time crunch and you just can't resolve it in a week, but you may be able to resolve it, say, in 3 weeks before the policy is issued.
Thank you, Karen. Judah, what is the shortest closing time you've seen for banks versus a private lender? Is there a certain closing time requirement you don't even bother trying to do bank financing?
I would say with a bank, a good rule of thumb is if you have a good relationship and it's the right type of bank, we've gotten stuff done in less than 30 days with banks, and perhaps shorter, again, just depending on the circumstances. But if you have a week, chances are it's not going to be a bank.
Very true. I guess that's all private. Hey, Mike, last question is for you. Given the liquidity in the capital markets, it seems like there are increasingly more and more private lenders popping up with the similar rates. Why would someone choose your company over another one who's offering essentially the same thing?
Well, yeah, there are quite a few competitors in our space these days. But
They're all terrible.
yeah, right.
Absolutely.
I mean,
That's a good answer, Ori.
There's a 3-word answer. It's
You just answered it.
Certainty of
that's actually what I was about to say. I mean, a term sheet without execution behind it is worth the paper it's printed on. I mean, there are a lot of people out. There's a lot of liquidity in the market, and a lot of people have said, "Hey, you know what? I want to be a private lender." That doesn't mean they know how to lend that money efficiently, and it certainly doesn't mean they have a team behind them, that can close in a week. One of the complaints I've heard from brokers and borrowers working with other lenders is the closing process was a nightmare. We signed this deal up; they were great. It's almost like when you're moving and you work with a moving company, like everything changes, the rate changes, the lender digs their heel in. We pride ourselves on being flexible right up until the closing. We've had deals where we've had guarantees and pledges, and we've let them go even after the process. I think I've worked with everyone on this call, and I think they would attest to the fact that we're in the business of closing loans. If we sign something up, we're not making excuses. We're not changing anything, and we're going to deliver what we say. And even though our 7% might be the same as somebody else's, I think you get that certainty of execution from us, and also 15 years of experience. We did this through the last financial crisis, and we're still standing, and we'll still be standing after this one too.
Great. Thank you, Mike. Mike, Judah, Karen, Ori, real pleasure, real honor to have you guys on. Very informative. Really learned a lot. I did. So I just want to thank Emerald Creek Capital again, as they will be back next month, and they actually have three-part series. So we're going to hear from them again in March, and as well as in April. And there'll also be an extra bonus. I believe one of the, whether it's Mike or someone else from Emerald Creek, will also be at the virtual expo in April. So once again, I want to thank everybody. Mike's team will send out a thank you letter to everyone with everybody's contact information here, as well as within 2 days, this video will be available for you guys to use or submit out or send out to anybody. But once again, I want to thank Mike, and I want to thank Emerald Creek Capital for being the sponsor of this webinar. And everybody have a great day, including you, Ori. I know you've been looking out that window 20 times. So enjoy the day, Ori.
Productive. I don't know. The beach is calling me. I don't get work done down here.
Yeah, definitely. Enjoy, guys. Enjoy. Thank you, everybody.
Thank you.
Thank you. Take
Thank
care.
you.